In today's video, we're going to be going over the ultimate trading guide, meaning the psychology behind trading, a trading strategy, developing a good risk to reward system, and everything you need to know to be able to become a profitable day trader. All right, so first we need to know what is a fair value gap. So a fair value gap is basically a 3-candle pattern where the wick of the first candle and the wick of the third candle don't overlap. So here we can see a bearish example where the wick of the first candle and the wick of the third candle do not overlap within this candle, therefore leaving this gap, which is what we consider our fair value gap. And if we go over here, we can see a bullish example where the wick of the first candle and the wick of the third candle do not overlap in between this candle, therefore we left this gap, which is our fair value gap. Next, we need to understand what is liquidity. Liquidity is basically where stop losses are. So in most cases, retail traders put their stop losses above old highs and below old lows. Therefore, those highs and lows now become a draw on liquidity. So if we can see in this example here, let's say you were to short here, most retail traders would put their stop loss above this high. And if we look down here, let's say you were to get into a long position here, most retail traders would put their stop loss at this low. Therefore, there are stop losses resting above this high and there are stop losses resting below this low. Now let's go over a few different types of liquidity. So first we have equal highs and equal lows. Equal highs and equal lows are basically where you can see that right here, these two highs were identically to the tick and they stopped right at the tick. So they are considered now equal highs, which is a really strong draw on liquidity because retail traders would see this as a double top. Here we have LRLR, which is basically trendline liquidity, where retail traders would short off this trend line because they see this as a trend line. Instead, what you have to see this as is liquidity being engineered to then get ran through. Next, we have swing high and swing lows, which is what we went over in our previous examples, which is just a normal swing high where retail traders would put their stop losses above and normal swing lows where retail traders would put their stop losses below. Then we have data highs and data lows, which is basically, let's say there's red folder news at 8:30, which by the way, if you go to forexfactory.com, you can see all of that. And it forms a ginormous wick like this. This is a really strong draw on liquidity because retail traders, let's say, would see this as a demand zone. Therefore, they put their stop loss below this wick, when in reality, what this is a data low, which is a really strong magnet for liquidity. And finally, we have what is an IFVG. An inverse fair value gap is basically a normal fair value gap, but instead of price supporting it, we decide to disrespect it and run through it. Or vice versa. We have a bearish fair value gap, and instead of price resisting it, we decide to disrespect it and run through it. So this is basically the bread and butter of my strategy. So what I do is I wait for, as the previous examples, I wait for a liquidity sweep and a bounce off of a normal fair value gap, and then good momentum over a bearish fair value gap or a bullish fair value gap, causing it to turn into an inverse fair value gap, which then would allow me to hop into my position. Now, it does not matter what strategy you use. If you have bad risk to reward, you will never be profitable. So in the case of my strategy where I use an inverse fair value gap, my stop loss isn't a hard set stop loss. It's a candle closure. So I've been asked before, how do you control your risk if you don't know where to get stopped out? Well, it's very simple. I wait for a candle closure, right? So I assume that we were going to close here. And now let's say I make an assumption that if we disrespect this again and proceed to close above, I'm going to make the assumption that we're going to close here. So what I'll do is I'll right click using the short position tool and I'll click on create limit order. Now let's say I want to risk $500. Right here it says 464. Now I know that if I go in with 29 contracts and it closes here or below or even a little bit above this, I am still within my $500 range, allowing me to manage my risk properly and not lose more than what I intended to lose. Now let's piece everything that we just learned together. So here we can see that we have an old swing high being buy side liquidity because a bunch of retail traders would put their stop loss at this high. You can see that we ran it with a good reaction off of it, as well as that to the left over here off screen, we're bouncing off of a fair value gap. Then here, as we showed in the previous example, we decided to disrespect this fair value gap, making it an inverse fair value gap where I hopped into my short position there. Then I right clicked on my short position tool and I made sure that I am within the limits of what I want to risk, targeting this LRLR, which as we stated previously, is basically a trend line to retail traders where they put their stop loss below the lowest low of the trend line, expecting for it to be used as support. But instead, what do? We dump straight through it and we run and we take out all of the LRLR. Now, finally, let's go over one final example using a different type of liquidity that we just learned about. By the way, all of these trades were called out to my Discord. I do one-on-one coaching calls with every single premium member using the data you give me. So that way I can personalize a course to you. So that way we can make it to any goal that you have set in mind. Going over this trade, we can see that we have this buy side liquidity here because it's an old swing high where retail traders would put their stop loss above. We come up and we run through it, bouncing off of this fair value gap at the same time As well as that, we inverse this bullish fair value gap, causing me to put my short position there, right-clicking on my short position tool, managing my risk properly, targeting these two equal lows, which to retail traders would be considered a double bottom. And finally, we have psychology. So this is Kenny, one of my premium members in my Discord. Link in the description again in case you're interested in the one-on-one coaching calls. He says, honestly, when I talked to you and we talked for that hour or so, that's when my losing streak turned around. You made me realize a lot when you were saying I'm a robot and only purely take if it's A+ or in your opinion, high probability. My emotions have been solid, and same with my conviction because I was a little all over the place when I talked to you. Basically, what he's saying here is before he talked to me, he was getting FOMO. He was getting really emotional over a win, over a loss, over a break even, or even if he didn't trade, he was getting emotional because he felt like he was missing out and not making money. But what a lot of people don't realize is the less you trade, the more money you make. Now, to a bunch of you, that might sound stupid, but the reason I say that is if you see just pure green candles going straight up, you are going to get FOMO. It's not in your rules to just trade if you see green candles. It's in your rules to trade whenever you see an A+ setup of yours. So why get FOMO and why risk losing money just because of the fact that you're scared to not make money? Stop losing money because you're scared of not making money. I would much rather have walked away from my computer, made $0 but lost $0 than have gotten FOMO and lost, let's say, $1,000. I told him, pretend like you're a robot. When you see an A+ setup, take it. If it loses, it lost, walk away. You're one and done for the day. If it won, cool, walk away. You're one and done for the day. If it stops you out break even, that's also fine. Walk away, you're one and done for the day. If you don't see an A+ setup, just don't trade. If you just think about it as a robot and you are just a machine staring at a computer doing the same thing over and over and over and over again, I promise you your psychology will get a lot better. And like I said, if you click that link in the description, I can get into a call with you one-on-one however often you want, and I can help you out personally with every losing streak that you have or with anything that you need with trading or psychology. That's going to be it for this video. I promise you, if you save this video and watch it over and over again and just follow what I'm telling you and go over the logic that I am telling you, you will become a much better trader a lot quicker. I've only been trading for 8 months and I've already gotten a bunch of payouts, and I'm already networking with a bunch of other traders and working on big things just because of the fact of my psychology. Not because I'm good at trading or bad at trading, not because I have a lot of money or I don't have a lot of money, purely based off of my psychology. If you pretend like you're a robot, I promise you it will help you out a lot in trading. I know it might sound ridiculous right now, but I promise you it will help you a lot in trading. Like I said, if you click that link in the description, I can help you personally one-on-one. And due to all the support that this channel has gotten, I am going to do a month of 50% off my lifetime fee. So instead of paying $900, you only pay me $450 and you never have to pay again. Thank you guys for watching, and I'll see you in the next video.